Welcome to the Market Structure course. In this lesson, we are going to break down the concept of market structure in the simplest way possible. We'll start from the basics, so you can easily understand how the market moves, why it moves the way it does, and how you can take advantage of these movements. Whether you're a complete beginner or someone looking to sharpen your skills, by the end of this, you'll have a solid understanding of market structure. So let's dive in. What is market structure? At its core, market structure is the way prices move in the market. Prices never move in a straight line. They go up, they go down, and sometimes they move sideways. Understanding this movement is essential to becoming a successful trader. Think of market structure as the backbone of how the market works. It's like understanding the rules of the game. Once you know the rules, you can start planning your strategy. Here are key points. Market structure shows how prices are trending. It helps traders identify potential entry and exit points. Understanding market structure gives you an edge in predicting future price movements. 2. The phases of market structure. There are 3 main phases of market structure: uptrend, bull market, bear market, sideways, consolidation. These phases repeat over and over, just like a cycle. Understanding each phase will help you know what stage the market is in and how to position your trades. Uptrend, bull market. An uptrend occurs when prices are consistently moving higher. This is called a bullish market, where buyers are in control, pushing prices up. Key signs of an uptrend. Higher highs, HH. Each new peak is higher than the previous one. Higher lows. Each new dip is higher than the previous dip. Example of an uptrend. Let's say a stock starts at $20, then goes up to $30. After a small dip to $25, it rises again to $40. Notice how both the highs and lows are moving upward. Tip for trading an uptrend. In an uptrend, you generally want to look for buying opportunities. If you buy when the price pulls back to a higher low, you're getting a good deal in a rising market. How to trade an uptrend. Look for pullbacks to the higher low. Enter your trade when the price starts to bounce off the higher low. Place your stop loss just below the higher low. Downtrend, bear market. A downtrend occurs when prices are consistently moving lower. This is called a bearish market, where sellers are in control, pushing prices down. Key signs of a downtrend. Lower lows, LL. Each new low is lower than the previous one. Lower highs, LH. Each new peak is lower than the previous peak. Example of a downtrend. Imagine a stock starts at $50, drops to $40, then rises slightly to $45 before falling to $35. Each low point is lower than the last, and each high point is lower too. This is a clear downtrend. Tip for trading a downtrend. In a downtrend, you want to look for selling opportunities. If you sell when the price pulls back to a lower high, you're getting in at a good point to profit as the market continues downward. How to trade a downtrend. Look for pullbacks to the lower high. Enter your trade when the price starts to fall from the lower high. Place your stop loss just above the lower high. Sideways range. In a sideways or range market, prices are moving back and forth between a support and resistance level. Buyers and sellers are in a tug-of-war, with neither side taking control. The market is in indecision mode. Key signs of a range. Prices bounce between a support and resistance. There is no clear trend up or down. Example of a range. Let's say a stock moves between $50 and $60 for several weeks. Each time it gets near $60, it falls back down, and each time it gets near $50, it bounces back up. Tip for trading a range. In a range, you can look for opportunities to buy at support and sell at resistance. However, always be cautious, as ranges can eventually break out into a strong trend in either direction. How to trade a range. Buy when the price touches the support and starts bouncing back up. Sell when the price reaches the resistance and starts turning down. If the price breaks out of the range, get ready for a new trend to form. 3. Advanced concepts in market structure. Now that we understand the basics of market structure, let's dive into some more advanced topics that will help you refine your trading strategy. Break of structure, BOS. A break of structure, OS, happens when the market breaks through a key level, signaling a possible change in the trend. This is one of the most important signals in market structure because it tells you that the market could be about to reverse or accelerate in the same direction. Key signs of a bullish. In an uptrend, the price breaks below the last higher low. In a downtrend, the price breaks above the last lower high. When a bullish happens, it's a signal to prepare for a change in trend. For example, if you're in an uptrend and the price breaks below the last higher low, it could mean the uptrend is over and a downtrend is starting. Steps for trading a bullish. Identify the swing highs and swing lows in the current trend. Watch for the market to break a key swing point. Wait for confirmation, price closing below the previous higher low in an uptrend or above the lower high in a downtrend. Enter the trade in the new direction of the trend. A change of character, CHOCH, is an important concept in trading that signals a potential shift in the market's trend. Unlike a break of structure, BOS, which confirms a continuation or a reversal of the current trend, CHOCH typically happens at the start of a new trend. It's the first sign that the market could be changing direction, from bullish to bearish, or from bearish to bullish. How to spot CHOCH. Identify the previous trend. First, determine whether the market is in an uptrend or downtrend. Look for the break. In an uptrend, a CHI is seen when the market breaks below the most recent higher low. In a downtrend, it's when the market breaks above the last lower high. Confirm the shift. Wait for price action to confirm the change. A single candle may not be enough. Wait for a close below or above the critical level to avoid false signals. How to use CHOCH in trading. Once a CHOCH is identified, it's time to prepare for a potential trend reversal. Traders often use CHOCH to enter trades early in the new trend, positioning themselves before the larger market participants catch on. For example, in an uptrend, if you spot a CHOCH, you may want to consider selling or closing your buy positions. In a downtrend, a CHOCH could be a signal to start looking for buying opportunities. CHOCH is a powerful concept because it helps traders catch early reversals, giving them the chance to ride the new trend from the start. Fakeouts and false breaks. A fakeout is when the market appears to break out of a key level, but then quickly reverses. This often traps traders who think the market is going to continue in that direction. How to avoid fakeouts. Wait for confirmation before entering a trade after a breakout. This means waiting for a strong candle to close beyond the breakout point. Use higher time frames to confirm breakouts. A breakout on a 1-hour chart may not hold on a daily chart. Market manipulation. Sometimes large players, like institutions, manipulate the market to trick retail traders. They might push the price up to trigger stop losses before sending the market back down, or they might create fakeouts to lure traders into the wrong direction. How to spot market manipulation. Watch for sharp price movements that don't seem to follow the usual market structure. Be cautious when the market moves quickly in one direction without a clear trend or volume to support it. 4. Understanding support and resistance. Support and resistance are key levels that the market respects. Understanding these levels gives you a huge advantage when trading market structure. Support and resistance basics. Support is a level where the price tends to stop falling and reverse. Think of it as the floor that holds the price up. Resistance is a level where the price tends to stop rising and reverse. Think of it as the ceiling that holds the price down. How to identify support and resistance. Look for areas on the chart where the price has reversed multiple times. Use horizontal lines to mark these areas on your chart. How to trade support and resistance. Buy at support. When the price approaches a support level and starts to bounce, this is a potential buying opportunity. Sell at resistance. When the price approaches a resistance level and starts to reverse, this is a potential selling opportunity. If the price breaks through support or resistance, be prepared to trade the breakout in the direction of the move. 5. Market structure and timeframes. Market structure looks different on various timeframes. A trend on the 1-hour chart might look like a pullback on the daily chart. This is why it's important to use multiple timeframes when analyzing market structure. By using multiple timeframes, you can get a better idea of the overall market structure and avoid getting trapped by short-term noise. How to use multiple timeframes. Higher timeframes, daily, weekly. These give you the big picture of the market's trend. Lower time frames, 1 hour, 15-minute. These show you the details of price action within the larger trend. Example of using multiple time frames. On the daily chart, the market is in an uptrend. On the 1 hour chart, there's a short-term pullback within that uptrend. You use the 1 hour chart to enter a trade at a higher low and ride the uptrend on the daily chart. Number 6. Mastering market structure. A trading plan. Now that you understand market structure, it's time to put it all together into a trading plan. A solid plan helps you stay disciplined and make consistent profits. A trading plan outlines when and how you'll enter trades based on market structure. Here's a simple plan to get you started. Identify the trend. Is the market in an uptrend, downtrend, or range? Wait for a pullback. Don't chase the market. Wait for the price to pull back to a higher low in an uptrend or lower high in a downtrend. Enter on confirmation. Once the price confirms the direction by forming a higher low or lower high, enter your trade. Place a stop loss. Protect your trade by placing a stop loss just below the higher low or above the lower high. Take profit. Set a target based on previous support resistance or the next key market structure level. Common mistakes to avoid: ignoring the trend. Always trade with the trend, not against it. Chasing the market. Wait for pullbacks. Don't enter trades after the market has already moved a lot. Overtrading. Stick to your plan and don't trade too often. 7. Conclusion. Understanding market structure is a game changer for your trading. By mastering trends, pullbacks, breakouts, and key levels, you'll be able to trade with more confidence and make smarter decisions. Here's a quick recap. Market structure is all about understanding the phases of the market: uptrend, downtrend, and range. Break of structure signals possible trend changes. Use support and resistance levels to guide your trades. Always use multiple time frames to get a full picture of the market. Remember, trading is a journey. As you practice and gain experience, your understanding of market structure will grow and your trading skills will improve. Stay patient, stick to your plan, and always learn from every trade. By following this guide and applying what you've learned, you'll be well on your way to becoming a successful trader. Trade smart, trade safe, and always stick to your plan. Don't forget to like and subscribe to Smart Trading Tactics. We've got plenty more lessons to help you sharpen your trading skills.